When people hear the term cyclical stocks, they often think of volatility. But volatility is not the definition here. Cyclical stocks are companies whose performance is closely tied to the economic cycle. So, when the economy expands, they tend to grow rapidly. But when the economy contracts, their revenues and profits often decline. Cyclical stocks are shares in companies whose revenues and profits move in cycles, following the broader economy. During periods of economic growth, consumers spend more, business investment increases, and demand rises. These companies benefit directly from that expansion. However, during recessions or slowdowns, demand weakens. Consumers reduce discretionary spending, businesses cut investments, and revenues fall. As a result, earnings decline and stock prices often follow. Common examples of cyclical industries are automotive manufacturers, airlines and travel companies, luxury goods brands, construction and real estate developers, as well as semiconductor and industrial equipment companies. Returns in cyclical stocks are typically generated through economic expansion. When the economy improves, revenues grow faster. Fixed costs, such as machine depreciation, insurance, or salaries of staff, are spread across higher sales volumes, which can significantly expand the profit margins. This operating leverage means that profits often grow faster than revenues during strong economic periods. Investors who buy during downturns and hold through recoveries may benefit from earnings growth and valuation expansion. The primary risk in cyclical investing is economic timing. If economic growth slows unexpectedly, revenues can decline quickly and the profit margins compress. Investors may reassess growth expectations, leading to falling valuations. These stocks can also be sensitive to interest rates, commodity prices, consumer confidence, and the global trade conditions. Time plays a critical role in cyclical investing. Economic cycles are unpredictable in length and intensity. Periods of expansion may last years. Downturns may arrive unexpectedly. Investors must understand that timing the cycle precisely is extremely difficult. Long-term investors often focus on purchasing cyclical companies at attractive valuations during periods of pessimism. That is when expectations are already low. If we are in a recession and Mercedes stock is down by 50%, the annual car sales is reduced from 1 million to 500,000 vehicles, then you are in a better risk-reward position if you were to purchase the stock. Cyclical stocks are not by default risky or safe. Their performance depends on economic conditions. They can deliver strong returns during expansions and sharp declines during contractions. Understanding where a company stands in the economic cycle is central to evaluating its potential. In investing, cycles repeat, but their timing never repeats exactly the same way. Recognizing that uncertainty is part of disciplined decision-making.